Hey everyone, it's Ed Kime from over at Quancha, and in this video we're going to talk about InvestOps, the flexible and structured process that you can follow today to improve your investment operations. Now before we dig into the details, I want to provide you with a little bit of context. We at Quancha build an options investing platform, and over the years we've had a need to improve the way we talk about investment process with our customers and users. And so InvestOps was born from our experience as a software company where our features are driven by user requests and other feedback. So, years of asking the question, what are you trying to do, has helped us really understand the process that investors tend to follow, even when it's not specifically written out in a step by step manner. So, as our platform has evolved, we found that our questions from customers they used to be, how do I perform a given task? And that was often to find a specific kind of trade or to manage a book in a certain way or to look for a certain option. But as the tools have evolved, we found that the questions have become a little bit more process oriented, which means instead of asking for specific features in a product about how to solve a specific problem related to an investment, it's more about the generic, how do I invest better through the process where I'm building my view or where I'm planning my trades or when I'm managing my book. And so as we've looked over the years to improve our tools to better answer those questions, we found that there really tends to be a lot of tension between the flexibility of our tools and the structure that our tools enforce. However, from the user perspective, everyone always wants more flexibility and more structure. What they want are tools that support investing in unique and unrestricted ways because, as option investors, the way we succeed is we look for opportunities where we go against the market, where we see something in the market that we think is either underappreciated or is overvalued, and we try to find ways to profit off of that. So the flexibility needs to be there to support so many scenarios that we don't even consider as product designers. But at the same time, users also want tools that are going to be consistent across investments. So this means that tools that not only approach investments in a similar way, but guide them through the investment process in a way that can be repeated across different kinds of investments. So we went out and we started looking for a process to adopt. What's the way people are guided into in both the retail and professional spaces for evaluating investments and planning them and managing them and pushing them all the way out through and then reviewing them at the end. And unfortunately, we found that there really isn't much process out there. We found that when we looked for that one solution that can help people with their investment operations, there really is no answer. So we coined the term InvestOps for a process framework that for managing your investments. It's really about taking your investment operations and dividing them up into 6 stages that have clear boundaries and relationships between them. Now, this is a very important consideration because what it means is that in these 6 stages, and you can get a preview of that in the top right corner here, the develop, plan, trade, monitor, adjust, and then finally out to review. When all that stuff happens, the specific tasks and the specific goals that you have in a given stage are really siloed into that stage, and you accept input from a previous stage and you provide output to the next stage. But the important thing is by putting those distinctions in, those boundaries and their relationships, it makes it much easier for people to approach investing and to really be more reflective and understanding of where they are in their investment process for a specific investment. And a very important thing is, while we've talked a bit about Quancha here, we've talked about option investing, InvestOps really is medium agnostic, which means that it's not tied to any specific approach in terms of the tools you use. It's not tied to any specific type of investing. And it's important to talk about the fact that InvestOps is not guidance for the kinds of investments you should make. So this isn't pushing you to options. It's not telling you to look at capital markets at all. Even you could use this for real estate. You could use it for angel investing, any kind of investments you're looking to have. In addition, InvestOps doesn't provide specific patterns for how and when to invest, meaning that we don't talk about timing markets. We don't talk about signals to look for. It's entirely up to you and however you want to make investments, but we're looking to provide this framework that can help you organize your investment thinking and then follow a process through to completion so that you can build your skills in each of the stages. And finally, InvestOps is not recommendations for tools or platforms that you should use. While this was born from the product planning at Quancha, it really is not specific to Quancha. And while Quancha does have functionality that's designed to map to InvestOps, you could pick up and use InvestOps for anything. And it is something that we provide that's open. It's completely open source. It's up on GitHub. Anybody can contribute to it, and you can take any of the content and use it as you like. So now let's dig into the specific stages of InvestOps to better understand kind of the flow of how someone would take an investment idea and see it through to completion. So the first step we have here is developing a view. And this is the first stage of any investment. This is where you form your opinion by collecting any research and then testing your opinion by looking for flaws in it. And this is where I think the vast majority of tools, and especially fintech tool marketing goes, is all around helping people develop their view so they know what they want to trade. So this is everything up to the point where you build a trade plan, except it doesn't include the trade plan itself. So this is all about producing an actionable view. And we've got a few examples here. And the idea for a view is that it should be as specific as possible. So the first one here, we say XYZ should close over 100 by the end of the year. Now it's simple, it's precise, it's actionable, and it's good enough where if you're someone who buys stock and XYZ is well below 100, then you would see that as a good opportunity. And someone who is going to plan a trade around this view would have a very clear way of doing it. But maybe you're an options investor and you like to trade with short puts, or maybe you want to open a bullish call spread. I mean, there's a ton of ways that you can go about doing it, but the point is you need to have that view built before you move forward to your next step. As you move down to the next one, talking about beating earning estimates, this is a little bit more specific or a little more precise of a view, talking about the expected rise on an earnings beat and the drop of an earnings fail. Of course, it's going to come down to how accurate these views end up being. That will largely drive the success of your investment. But having a framework in place where you can look back later on and see how you planned out your trade can really help you understand how you perform, as well as improve as an investor over time. Now, we provide up on our site, and this is free in our training materials, and also it's available on the GitHub repo, a view development worksheet. And a view development worksheet is really, at this point, it's really just a Word doc, and I've got an example here. We've got a bunch of fields where you can start filling out things like the title and the date. So, if some snappy titles so you can remember what it was that you were investing in or thinking about investing in, a date for when the idea came from, subject. Usually this will be the stock or maybe a sector that you're looking to invest in. It could be something like maybe the dividend specifically would be covered, or the price of a stock, or the implied volatility, things like that. You also want to document what your expectations are, saying like, I expect it to rise or fall or what have you. Finally, you'll want to include research. And also, these documents just have a few bullets in them. You can obviously extend them as much as you want. You can add new fields, do any of that stuff. You also want to talk about research, your research and the risks that you see in the investment. And then finally, any events coming up, like earnings announcements and so on. And here's an example of like a view development worksheet that's put together for one of our hands-on exercises, if you check out our training that we'll link to later on. So we talk about XYZ trading up. This date was at the end of June of 2020. The subject being the XYZ stock. We're looking at price and volatility as being a couple of the key things to watch for. The expectation of the investor is that the stock should continue moving up into the earnings, and that the near-term move should be sharp based on maybe technical analysis, or in this case there was a golden cross, there was some historical movement research, and of course volatility is in line with expectations. Therefore, the risks that were seen was that earnings could be substantial, so there was concern bad news might run against the bullish expectations, and so therefore documenting the earnings is important. Now you'll notice here there's nothing about how to trade this. This doesn't talk about buying stock, calls, selling puts, any of that stuff. It simply sets up the view, because later on it's going to be important to go in and actually use that in the next stage. So if we go off and we take a look at the next stage, this is where we plan the trade. And the goal here is to build a detailed plan that expresses the view. So if during the trade planning you decide that the view didn't really fit your expectations, or maybe you can't find a trade, then it's important to go back to the develop stage and go back and consider redeveloping your view, or maybe adjusting it based on the current research or whatever concerns you might have. Now, the goal here is to start off with an entry plan that will give you precise legs that you want to enter in order to hold your position, in order to get into the investment. But you'll also want to include things like consideration for time horizon. So, in the event you have an earnings announcement coming up and you want to get out before earnings, well, then you might plan your option expirations related to that, or you might buy stock, and if you protect it with a put, or if you don't protect it, you might include that in the trade plan so that you can keep an eye on when you're going to be getting out. You'll also want to consider downside protection. So the hedging is important, as well as the impact that it would have on the rest of the book for that stock or on your overall portfolio and possibly other investments. Since a lot of times people like a given sector, like they might like technology, so they'll pick one stock and they'll load up on it, and then maybe there's another stock they have a great idea on. Well, you want to consider your existing holdings, of course, to make sure that you don't get too leveraged into one sector if that's not what you're specifically intending to do. Now, in addition to the entry plan and the impact analysis, you'll also want to include considerations for things like managing your trade. So the most important part of managing the trade is monitoring the positions themselves. And so this is not only monitoring the prices, but understanding where the stock is, the change in the stock, things like movement and implied volatility, upcoming earnings announcements, all those things that you want to care about, because those are going to be things that you monitor for later on. And then, depending on what happens while you're monitoring the trade, you'll want to understand what adjustments you expect to make, which could be rolling option legs. It could be when you want to close a trade. And of course, the exit plan is part of that adjustment criteria, is saying, hey, do you want to get out based on target profit or loss, or are there other circumstances that you would want to get out? For example, like not holding through earnings. And the goal here is to produce an actionable trade plan. And so there should be some way for you to trade a view, hopefully. But if there isn't, then of course you'll want to be able to recognize that there isn't a good trade plan, therefore go back and revisit the view, because not every great view is going to have a trade that you can execute that's going to get you where you want to go. So it's important not to force a fit. And here's an example also from our lab of a trade plan. It's a similar template from before. Again, you can download this off the site for free or from GitHub. And this is about, this is taking the view from earlier. So this is the view that we had. The date, the next day, we looked at creating a trade plan. We're using a bull call spread in this case. It happens to be an option trade. We see the capital at risk, the gain we're looking at, the expected return, some specific legs, how we want to trade it, some pricing that we're expecting to have. That's an important part of this because, again, the trade plan is planning the trade. What we're doing is we're specifically making a distinction between developing the view, planning the trade, and then the next step is going to be actually trading this plan. But what you want to avoid is the scenario where you get all excited in the view stage that you start opening orders, because that's not as disciplined as you should be when you're making real investments. And so again, we talk about understanding what the portfolio impact is going to be, time horizon for the trade. In this case, close no later than the expiration in 2 weeks. Happen to be a 2-week expiration for each option. And then on success, we'll recognize that this particular trade is talking about holding the options through expiration. So that might be something you have, or maybe you definitely want to close them before or at expiration, or maybe you're going to roll them. Those are things that would come up in your adjustment plan. The adjustment plan would say, like, if we see that the stock surges, maybe you roll up the position strikes and out a week, maybe get a little closer to earnings since there's a little bit of buffer there. And then we've got some area to talk about downside protection. So because it is an option spread, it is inherently hedged. We know exactly what our risk is here, and it's a risk that we're willing to take. And then some of the reasons we didn't take some of the other ideas, like, for example, the stock purchase would require too much capital, and maybe there was a put spread, but that didn't have the liquidity. Again, this is just a scenario example of something you can see, and you can walk through this in one of our hands-on exercises on our training site. So now that we have the trade plan in hand, we'll move up to the trading stage. Now, the trade stage is all about executing the trade plan as defined. So you generally should not deviate from the plan other than small things like order management. So, for example, in the previous trade plan we were looking at, it was $2.80 debit for the spread we were trying to enter. So what we would probably do is look at the spread and say, all right, maybe we'll try to open the order at 250 and see if we can move up. And once we hit 280, we'll basically stop there, because the plan was 280 is our entry point. So we really don't want to go out there and try to trade beyond that, because that wasn't the plan. We should go back and revisit the plan if we think the pricing's different. Another thing you can do, another little piece of flexibility for trading the plan, is legging in or out as appropriate. This can be if the liquidity is really bad for options. People will leg in or out of trades. There are comparable things related to this and other kinds of investing, but the point being that you don't want to start swapping in different, let's say, options or different alternative trades, because those weren't the ones you picked when it was time to plan the trade. So you plan the trade, now you trade the plan, and if it doesn't work out, then you can move back. And the goal here is to produce a set of positions that were matching what was generated in the trade plan. So it's pretty straightforward stuff there. Now, the next stage is one of the most often overlooked stages, which is monitoring positions. And this is really the vast majority of the time that you spend as an investor is monitoring your positions. So we developed a view, we planned a trade, we traded our plan, and now we're watching our investment in the market. And while we're sitting here, there's a bunch of things that are going to happen, from day to day. So it's a really passive process, and it waits on outside factors. There's not much you can personally do during this, which is why it's important to include adjustment criteria and the things you're going to monitor in your trade plan. So one of probably the most common thing is the passage of time, right? Every day you get one day closer to your expiration dates, or you get one day deeper into an investment, or closer to some kind of an event that's coming up. So that could be something that you monitor, is just, what's the day? Obviously that's an easy one, but it's important to keep in mind. But you'll also care about things like changes in market prices and interest rates, and any kind of news that comes up around earnings announcements, or changes in dividend or sector news, or geopolitical stuff. There's just stuff everywhere, and as an investor, these are the things you'll want to consider when you build your trade plan for monitoring. And of course, check out automated tools, because there's a lot of stuff out there that will watch the market for you and watch for news for you. These could be simple things that, like, your Google alerts, and of course price alerts you can get from different sites, and that stuff will really help you stay on top of your monitoring. And now, somewhere along the line, something could happen that may kick in your adjustment process, meaning that this may produce a need to adjust the investment. And a lot of times sometimes you might feel the need, especially if you trade an options book, is you may feel the need to more proactively manage your book of options. And that's something you should think about during the trade planning, because you don't want to just kind of randomly be looking at the market every day deciding whether or not you're going to roll a leg, unless that's something that's specific to your trade plan. Like if you're selling premium in a delta neutral book, like part of your adjustment might be that you're going to look for opportunities in the market and then adjust on a regular basis. But on the other hand, if you're someone who is trading a covered call and you decide that you're going to roll it when you're within 15 days of expiration, you might start feeling the itch at 20 days. But the goal here is to follow that trade plan. But maybe when something comes up and it triggers your need to adjust the investment, that's where the adjusting the book stage comes in. So this is the stage where you determine when and how to adjust it. And most of the time, it doesn't really matter how you got here. So even though that monitoring stage might notice a price fluctuation that triggers your need to adjust the book, you want to really continue to follow your trade plan. And if you get to the point where something's so substantial has happened when you're monitoring, like a really, really bad earnings report or a really good earnings report, then you might want to go back and revisit your view to determine whether or not you want to continue to be in this trade, or if you want to substantially change the view you have on the stock. A lot of times people might try to adjust a book into a new view, which is okay to do if it's what you're specifically doing. I mean, if you feel that your view has changed, then you should definitely monitor the market and then adjust your book as needed. Now, if your trade plan is impacted, and or rather, if the trade plan indication is that maybe you're going to make some book adjustments here that don't involve exiting, then you'll want to start planning those out here in sort of like a mini trade plan. Always doing nothing is almost always an option. except for in the case of time specific things like trades leading into earnings or options approaching expiration. You can almost always do nothing and just go back and continue to monitor. But anyway, if you do need to do something, you'll want to produce an adjustment trade plan, which can either be a new trade plan doc or it can be an update to your previous one. I usually like to copy those and then keep a copy of the original one and then have a secondary one that shows any adjustments along the way with a date. And then when you get to an adjustment plan, I mean, if you're going to be exiting the investment and closing the positions, then you don't really need a plan for that because you're just going to go trade to close. But otherwise, you might want to add, remove, or scale positions or just roll and replace positions. And doing that, of course, should be driven by what your trade plan has to say. Now, the last stage is the review stage, and this occurs after you've closed your investment. This is where you have all the data behind you now. You understand what your view was, your trade plan, you monitored it, you adjusted it as needed, you traded along the way, and then finally you're at the point where you're reviewing the trade. So the review needs to take into account everything that went into the trade, or rather the investment in this case, because you might have multiple trades during that monitor adjust trade cycle. So you want to take into account everything that happened so that you can start to develop an objective history of your different investments over time. That's the best way that you're going to be able to improve your investment ability, which is what one of the most common things we get asked at Quancha is, how do I learn from things I've done? And so that's been a place where we've had a lot of focus over the past year and a half, is helping people understand and learn from their trade history. And this requires an honest self-assessment that may be painful, because there are times when you will have an investment that's profitable, but it's profitable because you got lucky. Maybe your view is wrong, but you traded it fortunately, or maybe some news broke somewhere along the line that saved the trade for you. On the other hand, there's also times when you might have had a great view, you might have followed everything you're supposed to do, but eventually just the trade didn't pan out because of bad luck that happened along the way, and you'll want to be fair about that as well. Now, the goal of this stage is to produce a post-mortem review that has any of the key details that you want to include for yourself to learn from in the future. Think of it as almost like the cheat sheet you wish you would have had when you were developing the view. And so the idea here is you want to critique your initial view and your strategy. So you'll want to start off by saying, all right, was I right? Did I properly interpret the data I got? Did I look for the right research? Did I make an honest effort to critique the view? Or did I just kind of look for evidence that supported how I wanted to trade anyway? And then you'll also want to take a look at your trade strategy, so how you planned the trade, and recognize, like, did I make the right call? Like, was it right to buy these options, or was it right to sell the stock short, or whatever it happens to be? Because there usually should have been some alternatives that you included in your trade plan, and you can kind of get an idea of how those may have performed had you gone with those routes instead. Another thing you'll want to do is you'll want to evaluate your own performance and, of course, your adherence to whatever process you followed, such as, in this case, InvestOps. Because a lot of times we like to put build a view and then plan a trade, but then sometimes we don't stick to the trade plan, and that can be getting in trouble. And one of the places where that can really get you in trouble is when it comes to exit criteria. So this can be, maybe you've decided that you're going to take profit at 50%, but then it hits 50% quickly and you decide, let me hold on for a bit. And you hold on and it slips away, which is something that's happened to almost everybody. And so you really want to be honest and evaluate your performance and how well you adhered to the process. And then finally, think about all the tools that you use and the places that will need improvement along the way. And the reason we bring up the tool thing is because when you think about your investment operations process in these 6 separate stages, what you might start to realize is that there are tools that you're using for different stages that don't really fit for them. Unfortunately, because there hasn't really been a lot of structured process in the industry, a lot of investors kind of go out to their brokerage site and they use what the broker provides. And maybe they, there's other tools like Yahoo Finance where you might take those tools and use them to support your investing along the way. But they're not necessarily designed for the things you're using them for. And a good example is if you're using like let's say Yahoo Finance for your quotes because you don't have real-time quotes with your broker, and so you're trying to trade the real-time data using that you're getting from Yahoo inside your broker UI, and you can realize that maybe it's worthwhile to upgrade to those real-time quotes because it'll improve your efficiency along the way and there'll be less room for error. And so those are the kinds of honest self-reflection points that you'll want to bring up as you do a post-mortem. And we provide a template for that. And so as well, just like the view development worksheet and the trade plan. And this is a good example. Again, this is a fictitious scenario, so it was really easy to be profitable. So we talk about the view we had, the date, the strategy that was in place, and this would be for your actual return analysis. So we know we had this capital at risk, we know we had this gain, we can see what the return would have been, and then we talk about the history, right? We opened the trade and then we exited it on the 10th. It could have had rolls in there, it could have had other things, and there are some tools that'll help you generate history from your investment based on what your transactions were. So obviously you might not need to do this all by hand, but it's available if you want to. And then you'll want to go back and do a pretty honest review of the different stages. So for example, the view analysis. Yeah, the directional view was accurate in this scenario and the magnitude was larger than expected. Now this is, while it's positive that we were right about the view, the fact that the magnitude was larger means that we underestimated it and we lost out on some potential profit there. We could have made more money had we been more aggressive on the trade. But the only way we're going to really learn from that is if we're honest about not having seen the full opportunity. Then we talk about the trade plan. In this case, we probably should have included more price and time frame detail for rolling up the trade. So in this case, because we talked about the stock in this scenario probably moved up a little faster than we had expected, and therefore we probably had some time to roll up, but we didn't have enough detail on what the pricing and time frame should have been. So in this case, we opted not to do that. Finally, we talk about monitoring. In this case, we were just looking at underlying price, so it wasn't that big of a deal. And then the adjustment analysis, we didn't adjust, but we probably could have. And then finally, just a bit of talk about the process overall, critiquing whether we followed it and how well it fit. And then some general notes. This is kind of the cheat sheet for what you'd want to know before you were going to trade. And these three sample sheets come into play in some of the training we have on our site. And so we'll provide some resources here. One is we've got an overview site at InvestOps.com that'll have some general overview details similar to this presentation. If you want to contribute to InvestOps, so you want to, for example, add different worksheets, you want to extend the ones that are there, or maybe you have other ideas for content that would be useful for other investors, you can do that at GitHub. And we have free training at docs.quantra.com/learn. So this is our training site. And so if we come up out here, so we've got at Quantra Learn, we've got 3 courses. We've got Getting Started with InvestOps, which talks about each of these stages in more depth and gives you a lot of good detail on the things that you would do in those given stages. We've also got something called Applied InvestOps, and Applied InvestOps takes a scenario and follows through step by step of a fictitious investor and how they would follow this. And then finally, we've got an InvestOps with Quantra course that talks about how you can use InvestOps with Quantra today. So going back to the Getting Started one, just to give you an idea of an example of one of these, there's a bunch of different lessons along the way. We've got a quiz at the end for you to test yourself. We've got, let's take for example, planning an investment. This is a good step. This is really the trade plan. So we talk about the stage input, plan considerations, questions you should be asking yourself, time horizon, things about downside protection, how you should plan to adjust. And again, it's not how you should adjust, but it's more saying how you should approach thinking about planning to adjust. This way you can be better with the way you do the investment. The Applied InvestOps course, this talks about a scenario with a backstory. So there's a fictitious investor, Mark in this case, and then they are looking at a scenario and they're going to develop a view against that, and then develop the view to build a view development worksheet. It talks about the time of day and all that other stuff. This way it goes all the way through to the end so that you can kind of see how somebody would use this in a real world scenario. And then finally, the InvestOps with Quantra just talks about all the specific features and things we have along the way. So for example, we've got like in our planning a trade, this talks about tools that you can use to help find specific trades with Quantra, depending on how you're planning to planning to trade your strategy. So once you have your view and you say, I'm looking for this price target or this time frame or whatever, you'll be able to learn more about that there. And so with that, I'm going to wish everyone the best of luck with their investments. And as always, good luck and good hunting.